Welcome, everyone. We're going to get started with today's webinar. I'm Allison LaForgia. I am the Senior Webinar and Events Manager at HW Media. Today, our topic is Appraisal Bias Roundtable with Homegenius Real Estate, Fannie Mae, and Rocket Mortgage. Today's webinar is brought to us by Homegenius. A few housekeeping items before we get started. There will be a Q&A session towards the end of the webinar. You can submit questions at any time by using the Q&A icon at the bottom of your screen. Also, if you miss anything from today's conversation or want to share it, the webinar will be recorded and a recording will be sent to all registrants in the next few days. Now with that, I'm going to hand things over to today's moderator, Kade Clark. Kade, the floor is yours.
Great, thank you, Allison, and thank you to HousingWire for allowing us the opportunity to speak on appraisal bias, as it is certainly something that we need to continue to closely monitor. But with that said, it is a very sensitive topic and we are cognizant of that. So today we're going to focus on understanding the data and research that's associated with it, and then turn our focus to the challenges associated with solutions that we feel as a group need to be implemented in order to potentially reduce the under and over property valuations that we are seeing nationwide. So with that, again, my name is Kade Clark. I'm the Senior Vice President from Homegenius. I run the digital valuations and sales team. We also have with us Rachel Robinson, who is the Director of Collateral Policy and Product Development with Rocket Mortgage. Welcome, Rachel. We also have Steve Gaenzler. Steve is the Senior Vice President of Product, Data, and Analytics with Homegenius. And then last but not least, someone who probably doesn't really need an introduction as he's well known in the industry. I'd like to welcome Senior Director of Policy with Fannie Mae, Lyle Radke. Thank you, everybody, for joining. So with that, we'll just go ahead and get started. Lyle, let's start with you. As reported, there have been recent studies conducted on appraisal values in underserved neighborhoods versus predominantly white neighborhoods, where the appraisal values on average came in lower than the contract price. Most know, but for those that don't, Fannie was a participant in one of these studies and released their own findings on the topic. Would you please provide insight on Fannie's conclusions and what resources were used to substantiate them?
Yeah, thanks, Kade. First, I want to explain what it was that we looked at and kind of why we chose to structure the study the way we did. We looked at refinance transactions. We did not look at purchase transactions. And one of the reasons that we looked at refinance transactions specifically is because with a refinance, we know we may potentially know who the appraiser would have encountered at the house. So the question in play is the appraiser somehow, whether consciously or subconsciously, biased by the race of the borrower? Well, in a purchase transaction, the borrower is the buyer. They're not in the house yet, right? And in fact, the appraiser may meet a realtor, or they may meet the seller, or they may not meet anybody. They may just let themselves in with the lockbox. So it's a little bit uncertain as to who they encountered. But with a refinance, it's much more likely that they encountered the borrower, who is the homeowner, who's in the home, and there's no one else involved. So being able to, control for that interaction was an important part of this study. The other thing is we collect, when we acquire the loans, we collect information which is voluntarily provided by borrowers about their demographics. The voluntary compliance rate is pretty high, so we have pretty good information on the borrower's ethnicity in the refinance transaction space. Now, one thing we don't know is the race of the appraiser. The race of appraisers is generally believed to be predominantly white, and so we made sort of that assumption, or that's sort of implicit in the study, but that's a potential gap, right? We don't really know the race of the appraiser. That said, we looked at about 2 million appraisals, for 1.8 million to be precise, for refinance transactions in the 2019 to 2020 period. We wanted to have, a complete closure on that. And we then compared these, or we grouped them according to the neighborhood demographics. So we wanted to understand, not only did the race of the borrower potentially biased, but what was the impact sliced by neighborhood? So what we found was that we found several things. First of all, when you look at just the average or median values compared to a benchmark, and I should talk a little bit about our benchmark, we used an automated valuation model as a benchmark. In fact, we used two different automated valuation models, AVMs. We'll talk about AVMs later today, I think, as our benchmarks. Now, AVMs themselves are not necessarily the absolute truth, right? If you knew that the AVM was right, you would just always use the AVM. You'd never get an appraisal. The fact that we still get appraisals is due to the fact that there's some uncertainty implicit in the modeling that that you use to create an AVM. But what we are able to look at is like different outcomes for relative to the AVM for the different racial groups. And so it's not necessarily that the appraisal is higher or lower than the AVM. The question is it higher or lower more frequently for one group than for another group? So it's the gap or the difference in rates that we're really going to look at here. Okay, so that's kind of the background. Now, what we found is that relative to the AVM, appraisals for blacks in black majority neighborhoods came in a little lower than the AVM, using either AVM. And these AVMs work very differently from each other. They're completely constructed in very different ways. So there's no, that gave us, we're really doing three tests here because you got two different AVMs to compare the appraisal to. And they work, those AVMs are very different. We found the appraisals for the black borrowers came in a little bit lower than the AVM. The difference was small. It ranged between 500 and about 1,500, 1,600, depending upon the AVM and the neighborhood on average, or actually median. What we found is for white borrowers in those same neighborhoods that the appraisal came in a little bit higher than the AVM. So there is a disparate impact relative to the AVMs. It is small though. Like I say, it's in the range of a few $1,000s, which is in today's market, median prices are 300,000. So it's a very small percentage, usually within 1% to 2% of the AVM on the median. All right, the next thing that we looked at, so you can look at median or average and you get sort of a big picture of what the whole population is behaving like, but you don't necessarily get the tails. So what this tells us is maybe bias is not that prevalent on the large population, but you still want to know, are there certain scenarios where bias is more active? And so we looked at the tails, and one thing we looked at was undervaluation. This is one of the prevalent concerns in the media is are black borrowers somehow being disadvantaged by getting lower values? And what we found is that whether it was in a black neighborhood or a white neighborhood, it came out about the same. So about 12%, roughly 12% of appraisals are below the AVM for both the black and the white borrowers in both the black and the white neighborhoods. That really didn't vary much. So that to us says undervaluation is not really that different. It's about the same for regardless of race. What we did look at then, it was the overvaluation, and that's where we found the biggest difference. So we found overvaluation rates for blacks varied between 10 and 13%, depending on the neighborhood. But for whites, we found that the overvaluation rate was 16% in the majority white neighborhoods and 23% in the majority black neighborhoods. So you see a much larger rate of overvaluation for whites in the black neighborhood. And that was maybe the most interesting finding of this study. You can draw your own conclusions what that meant. We also looked at the reasons, the top reasons why the overvaluation was occurring. And we found some difference between the two populations on this. So for white borrowers in black neighborhoods, what we found is that the location of the comparables was an issue on about one out of 6 of these potentially overvalued appraisals, where they're overvalued relative to the AVM. That comparable location issue only occurred about half as frequently for Black borrowers in Black neighborhoods. So that's, again, another interesting finding. It seems that for the white borrower in the Black neighborhood, the appraiser was more willing to go further out for comparables, whereas for the Black borrower in the Black neighborhood, they were more likely to stay close to home for the comparables. So that interesting correlation there. All right, so that's kind of it in a nutshell. What we took away from this is that on a large scale, undervaluation bias is not very much more common for Blacks than it is for whites. That said, we feel like any misvaluation, whether it's under or over valuation, is disadvantageous for any borrower, right? And so we're definitely doing all that we can to try and improve the tools, the scoring tools, the risk controls, to make sure that appraisals are as good as we can get them, and to try and help every borrower. Our goal is for every borrower to have an accurate and reliable appraisal.
Great, thanks, Lyle, for that additional information. You hit on one thing that I think is really important. Clearly, the housing boom put a spotlight on our appraiser shortage throughout the industry, right? But it also zeroed in on the fact that we have a lack of diverse appraisers in our industry. As a matter of fact, the Department of Labor's Bureau of Labor and Statistics shows 97.7% of appraisers today are white. So attracting new applicants, in particular those of color, are difficult. And I think, personally, the elephant in the room being the state and national requirements in order to become an appraiser. Recently, both GSEs released their equitable housing and finance plans. I was happy to see both zeroed in on this very topic and that we need to take action. Fannie, in particular, named their initiative ADI, which I'm sure you're aware of, the Appraiser Diversity Initiative. So I'd like you, if you could, to please expand on this for everyone and what your goals are from both a short-term and long-term for this initiative.
Well, we noticed back in 2018 that in our REO and loss mitigation activities, that there was a gap between the race of the borrowers and the race of the appraisers. So we use a panel of appraisers. We have a group of appraisers that we preferentially use for REO appraisals, and so we actually have relationships with them. We know them, and so we launched this initiative, the Appraiser Diversity Initiative, back in 2018 with a couple of goals in mind. One is to just attract new entrants into the appraisal profession, because it is, there's concerns about it's a little top heavy in terms of age, and there's a little concern that somewhere down the road we might see more retirements than incoming new appraisers, and that is a structural issue that would be detrimental to our business and to the industry as a whole. So we want new young appraisers. New appraisers, age isn't really the issue, but new appraisers coming into the profession to replace those who retire in the future. And along with that, I think there's a generally acknowledged societal benefit to having diversity, whether it's in academia or whether it's in the workplace or socially. The more that we interact with people that are maybe a little different from ourselves, the broader our experience, and the more points of view we get, the better our point of view becomes. It's great to be challenged, and so we felt like it's important to have as an appraiser profession that more closely represents the diversity in this great country of ours. And so we partnered with the Urban Institute and the Appraisal Institute. The Urban Institute helped us to find venues and to attract participants in the forums that we present. And the Appraisal Institute provides the qualifying education that the appraiser needs to get their initial license. So we established this ADI program, and we've been putting on seminars in local venues up until the pandemic started, and then we went virtual, of course. Lately this year, we've resumed some in-person events, and we have so far offered nearly 300 scholarships to aspiring appraisers. That's really ramped up this year. So most of those scholarships were actually offered in 2022 as the program has experienced a lot of growth. And because it's relatively new in terms of the volume of scholarships we've been able to offer, a lot of those new scholarship winners are still in the program, but we have 26 graduates from previous years, and those graduates, 18 of them have been placed with employment. So we're really excited about that. You've got 18 new appraisers out there working that came through our ADI program, and we're expecting that number to grow pretty dramatically over the coming year.
Are you finding it difficult to find people to step in and allow these people to work underneath them as trainees?
Yeah, that is one of the great challenges. So, finding supervisory appraisers is a great challenge, and then finding employment, or and sometimes those are the same thing, and sometimes those are different things. There are supervisors who might be willing to train an appraiser, but do they have work assignments to give to that appraiser? And then there might be employers willing to hire a trainee, but do they have a supervisor handy to assign, right? So both of those things, whether together or separate, are really important for us to solve in order to make this program successful.
Yeah, I agree. We certainly need more diversity, equity, and inclusion in all facets of our industry, that's for sure. Rachel, turning to you, staying on this same appraiser topic, the FHFA cleared the way for the use of desktop appraisals for purchase loans up to 90% LTV. In addition to helping aid in solutions surrounding the appraiser shortage and creating efficiency, some feel desktops, along with hybrid appraisals, will help mitigate unintentional bias. Do you agree or disagree?
Yeah, thanks, Kate. It's a great question. We've been participating with these types of appraisals for quite some time now. I think COVID was an interesting time frame that let us sort of understand the appraisal experience a little bit differently, as we were really limited in interacting with folks within their home, right? Obviously for health concerns. And so, I think it helped everyone sort of learn a lot at a broad scale. And so, there's the obvious reasons that you think about having an appraisal done in this way, just not having to drive around town and measure, it's a great efficiency play. And you think about, standardizing the data set, and also standardizing the way the information is collected. I mean, anytime you have an opportunity to move from an art form to more of a science, you're going to be mitigating bias, whether it be, just like Lyle mentioned, an intentional or an unintentional or a subconscious or unconscious sort of situation, right? And people bring bias to the table all the time. Getting stuck in a traffic jam and being really irritated and annoyed when you get to a work assignment can bring a whole set of experiences to, again, it's not something that you might be reacting to on purpose, but we're humans. And so when we have the opportunity to say, okay, listen, here's what we actually need to know about this property. This is the important part of the valuation. It's the data points on the home. We're trying to understand the collateral, right? And so being able to really focus in on that and leverage that to be able to then offer it to the appraiser, who can be apart from that situation, not necessarily interacting with any of the participants or the humans in the transaction, and really analyzing the data, in theoretically, all of that makes perfect sense. And what we see in practice is, now you ask, well, how do these appraisals perform? And so, from every level that we see, we see improvements on things like turn time and things like correction, addendum rates, right? Having to go back and do a revision, those things improve. And more importantly, from a risk perspective, we evaluate each of these appraisals, leveraging a risk component, leveraging the tools that the GSEs also aid us with. And what we see is that these appraisals perform just as well. And so I think, there's still more time to tell largely and at scale what we see, but so far, I think the outcome of these appraisal approaches and methodologies are very promising and will lead us down the right path.
Just out of curiosity, because I've heard it on both sides of the coin that some appraisers aren't comfortable setting a value from the desk. Some appraisers aren't comfortable from the hybrid space utilizing a third party's information from the on-site inspection. Have you ran into any instances where it's been difficult to place an appraisal because there's no appraisers available to take the order?
Yeah, I think that the response is sort of driven very much by how the program is being run. We have seen cases with different AMCs that we've worked with that have had incredible, wild success with adoption. And I think if you have the right tools and technology and training and understanding of how the process works, what it is that's being collected, how we're asking you to go about completing the valuation, the data set that we are using here is a very robust data set. And the technology that's out there, there are things out there today that pretty much give you a full scale rendition of what that house looks like. So it looks and feels as if you're actually, visiting that home, and you can understand things like obsolescence. And, so I think it really depends. If you have a very basic application and you're providing the bare minimum, you might run into some of those challenges. And we've seen that, but we've been able to overcome it through, leveraging better technology and really understanding, helping the appraiser to understand what it is that the task at hand is actually covering.
Yeah, I agree. The technology is going to be the key of getting adoption across to those who may not be quite ready to accept that kind of information and then set a value and put their name on it, right, and their license on it. So I think that's key. Steve, expanding on that last piece, technology, data, discussions around building out and revising risk assessment products such as AVMs to aid in identifying overvalued and undervalued properties that could potentially be a bias indicator have become more urgent. However, this leads me to other questions: data sources, data integrity, data frequency, modeling, testing, the use of AI, a myriad of different things. Would you please give us your thoughts on the use of AVMs and whether or not they could potentially be an indicator of bias that requires further review?
Yeah, that's a lot in there. Let me unpack it for you. When you think about it, so bias is a function of both intentional and learned behaviors, right? And that often causes unintentional and sometimes, but more often unintentional, but sometimes intentional actions. And so combating that is a combination of, I think, right, education and training, the diverse workforce you talked about earlier, and tools to monitor and measure in real time. So you just started talking about this a little bit. One of the benefits of the huge advances in technology and data over just the last decade is the impact that it has on monitoring and measuring. So for the first two, Lyle gave a great rundown of Fannie study. Freddie had a similar study at Purchase, so it's slightly different. Other folks like the National Fair Housing Alliance, American Enterprise Institute, you mentioned Urban Institute, many others have covered these first two in really deep and thoughtful ways, so education and diversity. One of the challenges we have, though, in growing the overall appraisal community, so going back to Lyle's earlier comment for a second, is this owner's path to licensure and certification, right? In many states, it requires a bachelor's degree, right, or associate's degree, hundreds of hours of classroom time, formal examinations, thousands of hours. You talked about the apprenticeships, and lots of money. In many states in the United States, it is harder to become a licensed appraiser than a commercial pilot, right? And why is that historically the case? Well, it was required to have all of this because the technology to support appraisers was very limited, meaning when an appraiser needed expert level training, right, to be able to respond to all the different edge case situations they might face, they had to be trained in advance to do it. But now I think data and technology can provide augmentation tools, and many of them are already in place, that will ultimately allow for a loosening of what I'll call the initial requirements to become an appraiser, right? And in support of actually, doing this without giving up any of your accuracy or performance with less training. So when you talk about AVMs, right, as an indicator of bias, AVMs are very, very useful in helping to apply what I'll call a standard mechanism to validate two things. One, the direction, high versus low, and magnitude, right, big versus small, of valuation differences relative to a benchmark. And Lyle, you mentioned they used AVMs as their benchmark. So what does it mean? It means that operationally an AVM model should apply the same mathematical process, so the same formula to all valuations. It's systematized. So it's by design it's trying not to be subjective. And therefore, that's why the result should be comparable, right? And provide a metric from which more human valuations can be measured against. Now, I agree with Lyle, you said this earlier. I wouldn't say that AVMs are always right? It can be different, but it's still comparable to another value, including an appraisal, because we can measure the performance in significant sample sizes, hundreds of thousands, not millions of AVMs, and therefore know the structure of what that model does and apply that as the benchmark against these other tools. And in fact, nowadays, many commercial grade AVMs are actually multiple models that evaluate properties simultaneously many times. I like to say that our Homegenius AVM is actually 500 opinions because the model generates hundreds of estimates, not just one estimate. And so that approach alone, where one value alone is not the basis, but rather hundreds of opinions evaluated in aggregate form, that helps to stabilize the value, make for an excellent point of comparison against these human values. And then having a proper escalation process, et cetera, et cetera. But notice, Kate, I didn't say it would specifically identify bias. So the causality of differences is not something that AVMs per se are generally focused towards. So what they can't do is explicitly identify the source of the bias. But you have a valuation, you get a valuation that's low in a neighborhood, but there might be a really good reason for it. And so we want to continue to build out models that help attribute the reasons for the differences in values. But as far as a comparative tool to identify potential bias, certainly an excellent option. And the last thing I'm going to say on this topic, the AVM of today is not the AVM we saw 5 or 10 years ago. We have much larger, cleaner data sources for modeling and for testing of those models. We have way better computational power. We have more variables that make them far more accurate than the past. However, I do believe that getting really, really widespread, broad acceptance of even AVMs will require that they finally cross over one of what I call the great challenges, and that is the AVM model's inability to see inside of a home and capture important finishes and conditions, importantly, and other data points that are only available right now through sight. And so I think when that happens, it's a watershed moment for the next generation of automated and interactive desktop and other type of tools. At Homegenius, we've invested heavily in computer vision skills, because we do believe that computer vision models have the distinct advantage of being built without data that will be influential in a biasing way. So you think about computer vision models, typically in our example, let's use it as an example, billions of images are used to train models. But those models don't contain any structured data field. So we don't know the address. We don't know any information about the owners, current or prior. We don't know any information about the participants in a transaction. And so the output, including our prediction of condition, is truly ignorant of any data element related to demographics that are usually the drivers of, in this case, racial bias. And so I really do think that the next generation of AVMs will be even more valuable in this kind of fight against bias, where you will start to see a difference between just identifying differences in values to help identify where you should go in your next step, versus actually being able to attribute bias in the actual analysis itself.
So I'm curious. So condition is obviously pretty subjective, depending on whomever is going out to the property. One may say it looks fair. One may say it looks average. How are you qualifying for that through machine learning?
It's a great question. It's very difficult. And again, sidebar our experience. We found that in order to train these models, and so in computer vision models, right, you take images and you label those images by hand. And so for the folks that are in there, you provide instructions, right? Rote instructions for folks to identify and follow. And we actually followed the guidance that Fannie Mae has on condition with regards to appraisals and the C1 through C6 condition scores. And we looked at those guidance that was provided to appraisers on what that should be, right? We provide that information to our set of labelers. And in fact, we found that there was quite a bit of subjectivity. So I actually went back and instead we went out and got actual appraisers and real estate experts to become those labelers to remove some of that subjectivity. Because you're right. If I'm labeling images and I'm asking people in various countries of the world what a bicycle is, it's pretty common. They're going to get it right. But when you say fair versus good, much more subjective. So it's a challenging exercise, but one I think that demands more investment. And I think there are great payoffs when you can do that in a commercial way.
Yeah, I certainly agree. Rachel, being the lender on the panel, I'm curious, where do you think AVMs fit based on what Steve's talking about?
Yeah, it's interesting. I mean, Steve said it best, like they've come a long way, obviously, over the past 5 to 10 years, but I still think that there is, you know, a limited application in the ecosystem right now. The things that Steve is talking about, the advancements that are being made in the technology are still just too new. AVMs do a great job when things are very consistent and homogeneous in property type and surrounding area. Where it starts to get real tricky is when you have different location types of factors, things like waterfront, different viewpoints or proximity to certain resources. You know, those things can really drive differential that the AVMs aren't always so great on picking up on. In addition, you know, the condition rating is a huge component, right? Even in a traditional appraisal, if you see 2 appraisers mark the house at a different condition rating and what that opens up availability for in selecting comparables, you know, I've seen differences between $100,000 and $200,000 in their property value. So when you think about a world where that isn't quite contemplated yet, it's challenging to think about broad use of an AVM. I do think that they have their place in trying to understand what's going on, different trends, things like that in the moment. And I can definitely see a future for where they will make more sense on a broader scale. We're not quite there yet.
Yeah, I hear you. We need testing and proof, right? At the end of the day. Lyle, I would love to get your perspective, not only because you used obviously AVMs in your study, but you utilize CU, collateral underwriter, to look at risk, right, associated with appraisals. Are you looking at any kind of AI associated to append and expand CU, or what are your updates that you're making and pertaining to that?
Yeah, Kate, great question. So we recently rolled out a number of changes to CU. One of those changes is a new message or flag. We call it the undervaluation risk flag. So that undervaluation risk flag is model driven, and it is intended to signal the risk, that an elevated risk of undervaluation in the appraisal. But to your question of what else are we planning? We have, similar to what Steve mentioned, we are looking at consuming photo data and machine capabilities of recognizing photos or imagery or interpreting imagery. We're also interested in employing GIS data to analyze locational influences. So I think there's some good upside potential. One of the biggest projects that we're working on right now is an update to the uniform appraisal data set and the appraisal forms. And we want to kind of transform the appraisal form into more discrete data elements as opposed to a lot of the narrative text that we have right now. And then I think that would create a new data source that we could use to enhance our AVMs around the margins, right? So a lot of times the reason why an AVM might underperform is, to Rachel's point, something about the property or the neighborhood is not homogeneous. And a great example would be if you have a water feature that substantially impacts value, and you've got homes that are on the water and homes that are not, I mean, they might be right next door to each other, but that can be a huge difference in value. Both identifying that characteristic and also modeling the impact on value of that characteristic are good challenges. Those are marginal issues because there aren't that many properties that are on the water, so to speak.
Yeah.
So let me see. Did I cover everything you wanted to ask? I think the other thing I wanted to say is about CU. So Steve, one of the things that CU does is it can actually tell at what point the AVM and the appraisal departed from each other. So there's kind of a unique design structure to our CU model that allows us to drill down and find those differences in behavior, if you will. And from that, we can output at a reporting level analytics around why the values are different, why the AVM is different from the appraisal, why two appraisals are different from each other. So that's something that's been really beneficial to us, and we want to continue to build on that. And the last thing I'd say, in maybe in a little bit of response to Rachel, is I think Rachel and I have talked offline about these topics, and I think we're very closely aligned on our view of the limitations of using AVMs. But one thing I think that's important to us is to understand the interplay between AVM confidence and loan level risk. And so I'll just throw out one example. Let's say you've got a house that's worth $500,000 and the borrower wants to borrow $100,000. And you use an AVM that's relatively low confidence, like you're not quite sure if this AVM is really giving you the right answer. The thing is, if that AVM's boundaries on the high confidence is like, say, 300,000 to 800,000, in any case, it's telling you the same thing about this loan. This loan is a good bet. The max LTV is 33%, right? The minimum LTV might be 12%. A very low balance, very safe, high quality loan. And so the AVM can help you in that situation, even when you may not have confidence in the AVM. So understanding that interplay between how precise do you need your value versus how precise is your AVM can really help you to understand when to use the AVM.
Steve, any follow-up?
Yeah, I think that at the end of the day, both make valid points, right, about the intersection between the data that you have and the results you're going to get. And we have the same issue with appraisers, right? If I take two appraisers and take them to the same house and blindfold and then release them at different times, I'm going to get two different values. So there is this, I think we have to be understanding of the context of what is evaluation difference and why is it? And is it something that is measurable or not measurable in our process? Because we have the same, information bias or model bias of appraisers, right? And we call it their subjective inference. And it's very valuable. I think one of the things that, one of the best benefits of the Great Recession from a housing perspective was the FHFA and the GSEs working together on data standardization, right? It makes it far, far easier to, both in the public sector, but also in the private sector, to start making advances more quickly that you can trust, right? The challenge in the past has been, I got model A built off this, and model B built off this, and model C built off this, and so I never have a true apples to apples comparison, right? Which is, frankly, even before some of the more recent direction from the GSEs on what to complete, how to complete within the appraisal documents, right? USPAP is not highly prescriptive. It's guidance on professional standards largely. And so with more prescription, you get better data. The offsetting challenge to that is one of the benefits that we say we get out of appraisers is their local market knowledge, right? It is that information. So if everything becomes a checkbox or a dropdown and fully standardized, we actually run the risk of losing information from our appraiser community. But luckily, again, since I'm in the data science field, there are really advanced now techniques in natural language processing that can take that information and find really valuable nuggets of information from that, especially within large samples of, let's say, appraiser comment fields, and identifying similarities, differences. And so models can train to help offset some of that. The data environment we live in today is very, very different. And so I think the way we think about automated products or augmenting products needs to be very different than they were in the past. And clearly with the GSEs and then obviously those in the private sector like Rocket, it's clear, right? There is a growing utilization and acceptance of that because they've tested it against other human methods.
Great segue, actually, because recently, as we all know, the CFPB just came out with some questions about regulating AVMs and the models associated with them pertaining to bias. So Steve, I'm curious, and this will be my last question on AVMs. Do you think the increased regulatory burdens deter innovation when it comes to potentially further mitigating bias?
Nothing is going to deter the private sector. Okay. Right? They're a passionate knowledge and truth. I mean, look, regulation always runs the risk, and particularly overregulation always runs the risk of, deterring innovation, tamping down on ideas and growth and the like. CFPB obviously is looking very closely at this topic. Historically, highly prescriptive rules and rulemaking rarely achieves the goal that it's intended to, the intended goal. And so I would hope that whatever decisions are made achieve two goals. One is they're really focused on use cases where there is risk. And I think, Lyle kind of pointed out an example in a lending situation where using an automated versus using a human does not create significant risk, one versus the other. There's others where there is risk. And so you have to be really cautious. And the second, I think the rules should be principle-based. Right, that you have to look at, the institutions that are bearing that risk within some confines and allow them to establish, based on principles, what the actual guidelines should be. If we do that, I think we allow ourselves to maintain that flow of information to continue to build out models, and you'll still get that. And I don't think the private sector will stop, but I do think it makes it harder for the private sector to not only build them but to use them, because when you use regulation, right? It's there is that which you have as a producer of the product, and then you have which as the user of the product. And so it's not just you got little players out there. It's not just little players in the vendor space, but it's also little players in the financial institution or user space that are impacted by heavy burdens of regulation. Yeah. But having some level of standardization is good. Right, it builds trust in the process, and more than ever, we need a system and a process that people will trust in these values and these valuations.
Yeah, I would agree with you, Steve, and I've heard multiple times from each of you the term standardization. So it's clear we need to standardize things across the industry in many different facets. Rachel, if you could expand on that a little bit more, where you're seeing more standardization needs to be implemented, that'd be great.
Yeah, actually, I think we've actually touched on it in a few spaces here. Standardization is helpful because we're talking about having methodologies of how we complete a process professionally, which is great. We want to do that, but having everybody collected in a uniform way is really needed. When you think of something as basic as just, using a tape measure, there's room for being able to do those things differently and make different calls and the way you measure, right? And so as we continue to move through this space of bringing new technology to the forefront, that is helpful in making sure that we are collecting things consistently and helping to eliminate some of the potential errors that could impact the outcome to the valuation. The same is true for defining not just the data points we need, but how we are selecting comparables and adjusting the different components regarding those comparables when compared to the subject property. We see inconsistency. We brought up condition on this call. Lyle brought up the forms. Anytime you have room for paragraphs of free form text, it's not just how you're writing the report and the information that can be interpreted differently, but there's a reader on the lender's end that's then trying to read that information and then get, a group of underwriters to interpret that information the same, right? And so when you start thinking about all of the different cogs in the wheel that have just, even if it's a little bit of discrepancy one way or the other, all of those things add up. So the more that we can standardize, modernize, and make sure that we are collecting things and analyzing things in a consistent method, then we're going to end up, in a better place where we at least have transparency and understanding of the how and the why and what the output is. So,
Thanks, Rachel. Lyle, I'll give you the last word on this one.
Well, I agree with Rachel, and of course, Fannie Mae has. We're all about standards. I mean, as much as anything, our policy is about setting standards for our customers and for their counterparties like appraisers. And some of the key areas where we are actively working on standard setting include the update to the Uniform Appraisal Data Set, the recent Fannie Mae policy adoption of the ANSI square footage methodology for measuring houses. And we've got other standards that we haven't publicly announced yet that we're working on in terms of property data collection. So there are, standardization is really important to us and it brings benefits. At the same time, I see the merit and agree with Steve's point that excessive standardization can result in a loss of information and can stifle innovation. And a great example of this would be like in the stock market. If you ever get on TV and watch these stock analysts on the stock shows, they argue about valuation, stock valuations all the time. And I would say a stock valuation is a really easy, simple problem compared to a house valuation, because 10 certificates of stock from Google are all exactly the same and interchangeable, right? And Google and any large corporation has to publish its financial statement to SEC standards. SEC is very much standardized the information and reporting in the financial industry, and that benefits the stock market. And yet the analysts disagree wildly. Some of them are saying buy, some of them are saying sell, some of them are saying hold. They have different targets. They think it's going to go here, they think it's going to go there. Like standardization doesn't solve the problem, right? And you still need to recognize that there's going to be differences of opinion, and sometimes there's merit in those differences of opinion. You don't necessarily want to discourage that. And also techniques can evolve, and they can evolve pretty quickly, and so you want to leave the door open for innovation. So I think you got to strike that balance, right? Standardization is great. Standardization can be a problem, an impediment, and you have to find that balance.
Yeah, clearly the PAVE report was pushing for standardization, right? And I'll only throw out one question to the panel pertaining to it. The use of value ranges, they seem to feel like that would help solve for unintentional bias. I personally do not see how that's even possible, but I'll throw it out to you all to give us your opinion on that. Rachel, you want to start?
Sure. Well, so I think we're just reinventing the same problem with different parameters, right? Because now it no longer becomes about what is the number that you're recommending, but about what is the range that you're recommending. And you've created a new ceiling in sort of a different space, whether it's at the bottom of the range or the top of the range. I think there's, that thought process to be contemplated. Also, the industry has been structured for quite some time around this full concept of a loan to value. When you have a range, if we continue on with this loan to value percentage, which drives a lot of other components of the transaction, now it becomes choosing a point within that range, which gets us right back to the same challenge. So I think it's an interesting thought process and approach. I just don't know how much of the problem of bias that it actually solves for.
Lyle?
I agree with both of Rachel's points. It's operationally difficult and clunky. What do you do with the range? And it doesn't really solve a bias problem. It just shifts it from are you biased in your point to are you biased in your range. I would also add that appraisers are not really trained to develop ranges of value. So how you define a range is kind of a statistical problem, and I don't know that that appraisers are equipped yet to take that on. So I think that would require some additional training and preparation for the profession.
Steve, last word?
Yeah, I tend to agree. I do think scientifically there are ways that you can actually create confidences around ranges, which actually would be beneficial as information. But by creating ranges, you're basically taking the onus of a highly trained professional and putting it on a loan officer or somebody making a credit decision who is even less trained to make that determination when it comes to actually establishing that LTV. And so I do think that there are probably informational benefits from it, but if we're using the appraisal community for their expertise, then they should be able to establish that actual value as their recommendation or opinion of value and pass that forward.
Yeah, I agree. Well, thank you all for your invaluable insights. We'll turn it over to the viewers' questions now. Allison?
So there are a good amount of questions. So the first thing I want to say to the audience is there's only about 8 minutes left in today's session. So if you have questions and you don't have time to get to them, we will be able to answer them afterwards. So continue to send in those questions and we'll do our best to get through as many as possible. So the first question that came up a couple of times that I do want to address is we shared a couple links already in the chat from Lyle's information earlier. So you can see the report that he referenced, as well as some information about the graduates from the ADI program. And those links are in the chat. Now, as far as the other questions that were submitted, the first question I want to get into is, sorry, scrolling through all of these, is for Lyle. Besides comps selection, did FNMA analyze errors such as incorrect condition and quality ratings for subjects and comparables, missed adverse location issues, and erroneous market conditions analysis? And if so, what are some of the results?
Thanks, Allison. So I'll answer it this way. We are planning a follow-up paper that will be the paper that we published back in February was more of a business report, and it gave a high-level summary. We're working on a follow-up paper that's more of an academic approach, and it'll get into answering those questions. But we have an economics team at Fannie Mae. They've done months and months of hard work on these questions, trying to sort out what are the potential influences on value that might be driving these differences. They've done like regression on over 70 different, tested over 70 different variables. And the variables you mentioned are among those: quality and condition and location and all kinds of other things, right? So all that'll be in the academic paper. And but what I will say is, without getting into the details of that too much, I will say that the academic paper confirms our findings. We think there's an unexplained component here, even after looking at all those variables in detail.
All right, thank you for that. It's always exciting to hear that there's more to come. And my next question would be, I'm interested in getting Steve's opinion on a comment that was in the chat. As a realtor, I use AVMs to benchmark individual CMAs. They cannot distinguish between the condition of the property, especially interiors. Example, for mica countertop versus solid material, new appliances versus old appliances. What are your thoughts on that, Steve?
Yeah, I have a strong opinion on this because we spent a significant amount of time looking into this question, and it's a terrific question, right? And it goes back to my earlier comment that the next watershed moment, I think, for automated technologies is the use of computer vision in these technologies. It is a challenging question. We have trained models at Homegenius that are soon to be deployed into our AVM platforms that actually do those things, that identify and distinguish not just objects of value, both inside and outside of a home, but even materials. So different types of flooring by room, countertop materials, differences in appliances, kind of things that you're talking to, Arvid, in your question. I think they're really important because that is that last, like that stretch in really closing the gap between those items of value. Appraising is a cognitive behavior. There's a lot of subjectivity in it. And so computational science applied to cognitive behavior science, I think will take us a lot closer. It's not there yet, but I do think there are very early indications of the quality of work that can be done with large image sets. And so we will get to that spot where both comp selections. So how do you, right, identify comparables, not just based on beds, bathroom, square footage, but based on condition of the kitchen, right? Or materials of the flooring, or age of the roof, right? Or vegetation outside, et cetera, or even things like off-street parking, which are oftentimes not included in some of the data sets. So the computer vision technologies are a data validation tool. They're also a standalone variable that can be used in modeling. So I would say there's a lot of folks I think that are working towards this, and I do think it's the next generation. And when it's there, I think it will make a big difference. You're muted.
Does anyone else want to hop in on that before we go to the next audience question? All right. So going back to something that came up more towards the end of the conversation about ranges, if an appraiser is to give a number for a client to use, and then a client looks for a range and selects a value to decision alone, who is now the appraiser? And would ranges increase the concern of bias? Anyone want to jump in first?
I think those are fair questions, right? And so how do you solve those questions? Then from Fannie Mae's perspective, we'd have to be somewhat prescriptive about how the person or the lender uses that range. And then you get into this whole debate about, being how prescriptive is too prescriptive, right? So I do agree that's a valid concern and an interesting question.
I think it also gets into, the point I had touched on earlier, which is there are lots of different approaches and ideas that when you talk about them in theory, you can see the merit. But when you think about deploying a scalable solution and making sure that it's consistent and that the outcome is consistent, that just introduces another variable that will be tricky to mitigate. And so Lyle said it, it's a great question and something we really have to be thoughtful about as we're thinking through the right approaches and solutions to these problems.
Well, I think you touched on it a little bit, Rachel, pertaining to what's the LTV if you have a range, right? At what point is MI inserted that's going to cost the borrower more money? So it opens it up to many different things that I just don't think make any sense at all.
You want to make sure folks are doing things the same way across the board, right? Now introducing another decision point that potentially one lender could look at differently than another. I mean, that's not the space that makes the most sense for the consumer, right? You want consistency and transparency. And so just something to think about.
Absolutely. All right. And unfortunately, we are out of time. Like I said, I know that there are a bunch of questions that are still in the chat and in the Q&A. We will be able to answer those after the conclusion of today's webinar. But I want to thank our panelists, Rachel, Lyle, Steve, Kade. Thank you so much for taking us through today's conversation. HousingWire will be sending a recording of the webinar to all registrants in the next few days, and the recording will be available in our Knowledge Center. Thank you all for joining us, and hopefully we see you again soon.